I definitely come to the conclusion after weighing all that sort of stuff, never bet against America. In my view, for most people, the best thing to do is to own the S&P 500 index. World War II, I was convinced of it during the Cuban Missile Crisis, 9/11, the financial crisis, that nothing could basically stop America.
This was Warren Buffett, the most famous advocate of owning US stocks, and he shared his thoughts on US stocks during the Berkshire Hathaway annual meeting of 2020. And he's right if you are looking to become financially free. Investing in US stocks and the S&P 500 specifically is a great way to do it. So let me explain why in this video. Alright, so let me start by sharing 4 important facts about the S&P 500 index. First, the S&P 500 is the greatest long-term wealth building machine available to the average investor. This graph here shows the long-term development of the S&P 500. If we assume you invested $10,000 back in 1980, your net worth would have grown to around $1 million in 2022. That represents an annualized return of 11.38%. And if you're taking an even longer term view, the return is closer to 10% annually. But still, an annualized return of 10% means your money will double every 7 years on average. And with this kind of potential, investing in the S&P 500 is almost a no-brainer. Secondly, the S&P 500 index is made up of 500 of the largest and leading companies in America. So the index is giving you exposure to some of the best businesses in the world. What's important to know, however, is that the S&P 500 is a market cap weighted index, which means that each component is weighted relative to its total market capitalization. So as a company's operations improve relative to the other S&P 500 members, the weight changes and the most successful companies will rise to the top of the index and have a higher weighting in the overall index. As of November 2022, for example, the 10 largest components of the index represent a significant percentage of the entire index and include businesses like Apple, Amazon, Microsoft or Berkshire Hathaway. And all I will say here is that it's hard to bet against the 500 largest and most successful US companies. Thirdly, be aware that the short-term performance of the S&P 500 may actually be a little more bumpy than the long-term performance may make it seem like. This graph here shows the yearly returns of the index. But obviously, if you want this, you need to be able to accept this. And fourthly, even though the S&P experienced some significant down years, as we just saw in that graph, there were some years during which the value of the S&P 500 declined 20, 38 or 47%, or declined 3 years in a row like in 2000, 2001 and 2002. If you take a longer term view, it's hard to lose money. If you consider rolling 10-year returns, for example, during 9 out of 10 periods, you saw a positive nominal return. And if you extend your time horizon even more to 20 years, you never lost money. And this brings us back to Buffett. Here's what he said during the 2020 Berkshire Hathaway meeting.
I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote and never pay it. You don't need to pay attention to them. I mean, the main thing to do, and you're not going to pick the bottom, and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more, and be comfortable with it as long as you're comfortable with the holding.
Now, obviously, US stocks seem to have something special about them. If we look at other international markets, we see that not all stock markets performed as well over the last 20 to 30 years as US stocks did. If we compare the S&P index to the German index DAX, for instance, we can see that the DAX performed quite well ever since 1993. An investor would have almost 8x his or her money, but the broad US index nonetheless significantly outperformed the German broad market index. If we take a look at other major indices, we will see a different picture. The Chinese Hang Seng Enterprise Index, for example, was basically flat over the last 15 years. The Japanese Nikkei's performance has been abysmal over the last 25 years. And the British Financial Times Stock Exchange 100 Index also significantly underperformed its American S&P 500 benchmark. And finally, this chart by BlackRock from 2021 highlights that US stocks have outperformed international stocks 8 out of the last 9 years and 10 out of the last 12 years. So why do US stocks perform so well? Well, you could argue that the US has a reputation for being extremely business-oriented. US companies experience much more support from the government and political leaders than in other regions of the world. There are better and arguably simpler regulations for businesses. There exists a business-friendly environment for startups with lots of funding opportunities. There's a good infrastructure and stronger protections of property rights in the US. The US is a high-spending consumer market and an open and liberal economy with lots of world-class talent, to name just a few examples here. And Buffett's perception that one should never bet against America is also backed up by scientific studies. In fact, several scientific studies have found that country-specific performance drives long-term stock returns, especially over the very long term. Country-specific economic performance matters. And while it can be argued that global diversification may protect investors against undesired outcomes of holding a concentrated position in countries with poor long-term economic performance, you will know, at least if you have watched some of my previous videos, that concentrated bets are part of every value investor's framework, and Warren Buffett's bet on US stocks specifically has most certainly made him rich. On October 16, 2008, during the Great Financial Crisis, Buffett wrote an article for the New York Times titled "Buy American, I Am." At the time of publication, October 16, 2008, US stock market indices were down roughly 30% amidst widespread market fear and a very negative investing sentiment. Today, in 2022, US stocks are also down significantly. But even though more than 14 years have passed since Buffett wrote this piece, what he wrote back then still applies today. Let me quote a few of the most relevant and important passages from that essay. The financial world is a mess, both in the United States and abroad. Its problems, moreover, have been leaking into the general economy, and the leaks are now turning into a gusher. In the near term, unemployment will rise, business activity will falter, and headlines will continue to be scary. So, I've been buying American stocks. Over the long term, the stock market news will be good. In the 20th century, the United States endured 2 world wars and other dramatic and expensive military conflicts. The Depression, a dozen or so recessions and financial panics, oil shocks, a flu epidemic, and the resignation of a disgraced president. Yet, the Dow Jones rose from 66 to 11,497. Today, people who hold cash equivalents feel comfortable. They shouldn't. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. Let me be clear on one point. I can't predict the short-term movements of the stock market. I haven't had the faintest idea as to whether stocks will be higher or lower a month or a year from now. What is likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up. Now obviously there's much more to say about this topic. I also have my problems with buying an index like the S&P 500. For example, it includes businesses in sectors such as energy, commodities or retail that are for the most part made up of average or below average companies. Moreover, indices are valuation agnostic. One of the largest components of the S&P, for example, is Tesla, a company that in my opinion is materially overvalued. And when you buy the index, you buy these stocks as well. Obviously, past performance is not indicative of future results. But due to the business-friendly environment in the United States and the ingenuity of the American people, I think there's a very good chance that US businesses will continue to prosper in the future. And with that, I'll wrap it up. Take care.